for years, I've been like Paul Revere, be careful, warning, the British are coming. I've been like Chicken Little, the sky is falling, and I've been a pessimist for all these years. But now I can't believe how bad it's gotten. I mean, it's here. And that old saying, cheer up, it could get worse. And what Peter says, well, cheer up, it's going to get worse anyway. It's worse than this. The good news is this: if it gets worse, you still have time to prepare.
The interesting thing is I'm not doing anything differently because I've been preparing for this crisis for a long time. In fact, a lot of people were making fun of me because I've been preparing for so long because they think that what I'm preparing for is never going to happen. Well, it's going to happen. It hasn't really started yet, but we're getting close. The problem is the Fed's been operating its monetary policy while looking in the rearview mirror because they keep creating inflation, right? Printing money, quantitative easing, whatever you want to call it. And they keep printing more and more money. And they look in the rearview mirror and they look at the CPI. And as long as it's below 2% or some version of it is below 2%, they think it's okay to keep printing money. Meanwhile, they're ignoring the road ahead. They keep looking in the rearview mirror at these CPI numbers. And they kept, printing money and inflating asset bubbles and distorting the economy and leading to these debt bubbles and letting the government get bigger and bigger and bigger, spending more and more borrowed money. And then all of a sudden they look in the windshield and they're staring at these big CPI increases, and their initial reaction is, oh, don't worry about it. It's nothing. It's transitory. It'll go away. And now they've got this huge problem, which has been inevitable for a decade. In fact, back in 2009, when the Fed first made the mistake of going down this road of quantitative easing and 0% interest rates, I predicted exactly the predicament that they're now going into, because they have this massive inflation problem. They can't do anything about it. They're talking about tightening up on policy, but what they're talking about doing is going from very loose policy to slightly less loose policy. They're not talking about tight money, which is what they would actually need to put out this inflation fire. But by tightening up a little bit, they're going to prick the bubbles, or they've already pricked the bubble, and you're seeing all these risk assets imploding right now in price. The economy is already rolling over into recession just because the Fed is supplying less monetary heroin than they were. But the fact that they're still supplying some means that the inflation problem is going to keep getting worse. So this is the Fed's worst nightmare. It's stagflation. And the question is, what are they going to do? Are they going to keep tightening up policy and push the economy into another financial crisis, not just a recession? Or are they going to reverse course, go back, reverse any rate hikes, expand quantitative easing, and just make the inflation problem much worse?
Peter, if it's going to get worse, what do we do? Kim and I have been preparing for this for years and years and years. Like I said, I invest with you. Kim and I have tons of gold and silver.
They often compare the inflation today to the 1970s to try to make it appear like it's not that bad. Oh yeah, it's 7%, but it's nothing like the 1970s. Well, it's actually worse than the 1970s. If you used the same CPI that was used to measure prices in the 1970s, and if you use that identical CPI today, last year was actually worse than any year during the decade of the 1970s. It was about 15%. And the bad news is 2022 is going to be even worse than 2021 because a lot of companies held back on price increases because they thought it was all transitory. Well, now that they realize that's not the case, you have a lot of companies that are rushing to make up for lost ground, and they're announcing major price hikes here in January. They're probably going to do more later in the year. Look at the price of oil. It's already exploding. It's up about 20% in the last few weeks. We're at a new high for the year. We're at $85 a barrel. I think we're headed over 100 this year, maybe closer to 150. I think by next year we'll be above 150 in the price of oil. It's not just oil. it's all sorts of energy, but it's agriculture, it's industrial materials. The government is trying to blame it on a supply shortage. It's not a shortage of supply, it's a surplus of money. It's all the money printing that is creating the problem. Had the Fed done the right thing after COVID and contracted money supply, then we wouldn't see these big price increases. Maybe there would have been a reduction in supply, but there would have been an offsetting reduction in demand. Instead, we reduced supply because everybody was staying at home instead of working, but we increased demand because we gave all the people who were staying at home more money to spend than what they used to earn when they actually went to work. So it was the worst of all policy mistakes. We threw gasoline on the inflation fire, and now we're dealing with the consequences, and it's just getting started.
The question is, if it's going to get worse. I was listening to Steve Hanke of John Hopkins University. He agrees 100% with you that it's money supply. It's M2. Just pure too much money in the system. But the question is, so what's going to happen? So if let's say they raise interest rates, they push us into a recession. That's going to crush a lot of small businesses, and if prices go up, there'll probably be more unemployment.
Yes. The problem is they're going to raise rates enough to crush the economy, but not enough to slow inflation. And in fact, as inflation gets worse, that's going to be another drag on the economy. And so what you've got to do, what I'm trying to tell you, is you got to get out of all of the bubble assets that were propped up by all the cheap money. Because even though money is cheap, it may be slightly less cheap for a while, and that's enough to collapse the bubble. But you can't just go to cash because inflation is very high and it's eroding away the value of your cash. There's no safety there. You can't buy bonds. Bonds are even worse than cash because it's cash in the future, but in the meanwhile, you're tying your cash up and inflation is eating it up. So people have to go out of these risky momentum stocks into value. And what we're seeing is a massive shift out of U.S. growth stocks to international value stocks, stocks in Europe, stocks in Asia, basic businesses that have real earnings right now, that pay good dividends right now. That's where investors are hiding out. That's why you're seeing some of these stocks up 10, 20% on the year with no news, even as U.S. tech stocks are cratering.
I really hate the stock market, Peter. I hate it. It's manipulated as hell. So I'm not saying you guys shouldn't do it, but I'm saying don't think there's a panacea. The moon will rise over the horizon on this one.
Right, but when you think about a stock market, you're thinking about the entire market, an index. Like, let's say your company, the Rich Dad Company, if you went public and it was at a good valuation, at a good dividend, maybe I would want to own part of the Rich Dad Company. I could buy shares in your business. I want to own businesses. I have to get out of cash, but I can't own, the momentum stocks. I can't own these, high-flying companies that don't have any earnings. And I can't buy cryptocurrencies, which have no value or no earnings. They went up along with everything else. I want to own something real. So I own businesses, tangible companies that have property, plant, equipment. And I also buy real money. I agree with you there. Buying gold, buying silver, buying mining stocks. That's where people are going to go.
Yeah, can I say one more thing, Peter? What's happening right now is for the real estate investors, we have too much money. It's shocking how much money we have in the tens of millions of dollars floating. We can't find a deal. So Kim and I are actively in the market looking for bigger investments, but it's more dangerous simply because the market's about to crash. If there's hyperinflation, my generation, the boomer generation, they're toast if they're fixed income.
The people who get hurt the most are the people who are retired. When you hear the news reports, they always want to focus on wages and whether wages are keeping pace with inflation, which they're clearly not. But at least if you've got wages and they're going up 5% and prices are going up 10%, well, you're only 5% poorer. But if you're retired and you've got a fixed income and prices go up 10%, you get stuck with the whole 10%. And, a lot of these retirees have been forced out on the risk curve. They've got all these overpriced stocks that pay no dividends, and those stocks are crashing right now, and their whole retirement is going up in smoke.
It made sense for these old guys like me, okay? And they had a stack of gold, and that would be a strategy for an old guy, old person. They could say, well, maybe I should get out of cash. I mean, cash is still going to be good, but it's going to be declining with inflation. But one strategy is to go to a hard asset thing. And what do you think is going to happen? Do you ever do a forecast what you think gold will be like in 5 years?
Yeah, I think it's going to be quite a bit higher, certainly in dollar terms, but also in terms of other currencies. But what you want to do with inflation is recognize that the biggest losers are creditors, people who are owed money and are going to be paid that money in depreciated currency. So you don't want to be a creditor in US dollars, so you don't want to own cash, you don't want to own bonds, you've got to own real things. And that's why I'm buying all these foreign stocks, companies that pay very high dividends. I mean, as the dollar goes down, the value of those dividends will go up. And of course, the companies that I own, they're all raising their prices now. So they're going to be able to raise their prices, so they're going to have higher earnings and they can pay me higher dividends. So those increasing dividends will keep pace with an increasing cost of living. But a lot of Americans have overpriced stocks that are falling, and if they have money in bonds, the low interest rates that they're earning are completely inadequate. They're being more than offset by inflation.